and some of the stuff should kind of get you a little emotionally involved. You should get a little upset because very simple principles that if we apply to our lives could have made a great difference. So that's what we're doing now. So we're going to begin tonight's briefing.
No.
Okay. We're going to.
Excuse me, sir.
Yes.
Who are you?
Oh, I'm sorry. My name is Andrew Cancel. I am an associate with Empower. I've been in the business for 8 months, and it's changed my life. It's some great stuff that we're doing and how we're helping people and educating the public. So definitely, if you have a pen and paper, take down any notes. If you need any, we have some for you. And we're going to bring our first presenter, BVP, Mr. Shane Young.
All right.
I had just enough time. I was like hoping Drew would talk for like 3 seconds longer, so I sent out the link. Just texted it to you. We got a couple people watching from Memphis. You got people watching Jesus from where?
Yes.
Ohio? So actually check your phone in a minute because you're gonna get a new link. The one that I sent. Yeah, they weren't on there yet, but the link that I sent you, there's a new one now. So just check your phone for that. So welcome everybody tonight to our briefing, and thank you for being here. We promise not to waste a minute of your time, and we'll be very efficient in what we communicate. My name's Shane Young, and I've been with Empower for about 3 years, really 2.5. I started out in Memphis, Tennessee, where I was a teacher and a coach, and ran my own nonprofit organization. And it took a lot to leave that and become full-time unemployable. And I say unemployable because now that I've been part of this business, no employer could afford my time anymore. And that's my dream, is to coach everybody that I know and love to be able to have that same experience of being unemployable. And so I just personally went from being a coach of kids, high school rugby players and even elementary school students, to being a coach now in the world of finance and really just life. It's funny how you think you're a leader in just one thing, business, finance, and really you become a leader and a mentor and like a psychologist even. And so what I love about it is just that when we can get someone to look in the mirror and identify what is it in my life that is holding me back from being successful, right? What is it in my life that's holding me back from being successful? It's usually, for most people, I think that it's usually 1 or 2 things, big things in our lives that are keeping us from being successful. And we can get someone to look in the mirror as a coach, help them identify what that is. And on the other side, when we look out into the world, what is it that's outside of me that can bring me success? And here at Empower, we have that. So we can be coaches and chew in the mirror and find out what it is that's holding you back. And then let's look outside and find out what it is that can move you forward. Isn't that cool? We can help people from both ends. And we do it all the time. And we start from a foundation of finance. And we've done a lot of different things. We've been in the utility business. We consider ourselves a consumer advocacy group. We'll tell you what that means in just a moment. First, I want you all to look at what's on the board here. And it's just our 6 steps to financial security. That's all. And they're huge and essential, every single one of them. I'll ask each one of you, not a lot of folks here, so I'm going to hit on everybody, to see if you have all 6 of these in your plan. And we just offer 2 services that encompass all of these. And if you disagree that you should not or don't need one of those, I want to know. And I probably will call your plan Swiss cheese finance, because Swiss cheese has big holes in it, right? And if you're missing one of the 6 steps to financial security, then there's a hole in your plan. You got to find out what it is. So number 1, Daniel, what's number 1? Increase cash flow. You didn't even look. I love it. Increase cash flow. How many people would like to increase their cash flow? Everybody would like to increase their cash flow, right? There's 2 ways to do that. The one is obvious and simple. It's to make more money. Wouldn't that increase your cash flow?
Yeah.
And then the other way is what? Spend less. So I always ask people, what would you rather do to complete step 1? Make more money or spend less money? Make more money, yeah. I think if we all got given $100,000 every day and somebody said you have to spend this all today or it's going to go away, you would do everything you can to spend that money, wouldn't you? I mean, just think about it. You would do everything in your power to spend that money. You might not even be able to, because you can't buy a house that quickly. It's a lot of paperwork involved. You would, maybe you'd go to the casino. I don't know. Go online shopping. So we would do that if we had enough cash. We don't all have access to $100,000 every day, so sometimes we have to find out ways to cut our expenses, trim the fat. Number two. What's number two, Drew? No, look. Just kidding. You can look at that.
Establish an emergency account.
Establish an emergency account. Establish an emergency account. So everybody's facing emergencies, right? In fact, we have folks in our own business that are facing emergencies right now. That's why they're not here. And so when it comes to an emergency, you have to deal with two things, right? Increasing cash flow was make more money or spend less. Well, emergencies is deal with the emergency and the loss of income you will experience from having to deal with that emergency. How many people think of an emergency and they think of a house burning down or just a car crash or something that everybody goes through? Correct? A lot of people don't think about, well, if I have to deal with an emergency, maybe I have enough saved to buy another car or pay for the mortgage or another house if it burns down or any of that. A lot of folks don't think of, what about my lack of income if I can't work anymore? So that's part of your emergency account, and we coach people to have half of your annual income saved up in an account to deal with emergencies, to pay for both the emergency and the lack of income that should come along with it. Would you like some time to deal with an emergency? Not have to clock in every day. So we coach people to have half of your annual income. So if you have $40,000 of annual income, then you should try to build $20,000 in an emergency account. That would feel nice to have, right? There's something you don't touch, something you have ready. What's number three, Jesus?
Number 3 is manage and eradicate debt.
Manage and eradicate debt. Everybody agree that debt kind of stinks? Anybody have debt they'd like to get rid of? Right. So I graduated college 3 years ago, and now I'm in this business talking to a lot of my friends I graduated with, and it's amazing to see where they are now because they paid all that money to go to school, right? Just to get a job, and then you work all those hours at a job just to pay for school. Who would do that? It sounds crazy, and yet it's what so many people here in America just do. Pay for school to get a job, to pay for school. And they spend so much time doing it. And so debt is so unfortunate because it drags you down, keeps the shackles on you. And we'll show you a video tonight that applies to paying down debt in terms of a house. However, it applies to all debt, medical bills, a car note, a mortgage is what is the example you'll see, student loans. Any type of debt, you owe somebody money. We've got something really compelling for you to watch. It'll be in a video tonight, so I won't harp too much on that. So that was number 1, 2, and 3. Does anybody disagree or think that we might not need 1, 2, or 3? Can we move on, or does anybody disagree? Everybody's on board with 1, 2, and 3?
Yep.
All right. Number 4. What was your name, sir? Kevin. What was number 4?
Ensure proper protection.
Ensure proper protection. I call that EPP. Okay? So ensure proper protection. This is the one that gets me. We insure a lot of things in our life, don't we? We insure our house. How many people insure their car? Right, they force you to, right? That's forced insurance. How many people insure their health? That's forced now too, isn't it? We have to. We don't have a choice. And you insure your cell phone. You insure your pet, your life. Some people might insure their toaster. I don't know. It's like a warranty, right? So we insure all those things in our life. And then when you think about it, what's the most important thing that pays for all that insurance? It's your income. How many people insure their income? I do. Okay? We're going to teach you how to insure your income. I always think of famous athletes because all famous athletes, millionaires, billionaires, they do it. They do it. So you can think of any athlete you want, the best quarterback, maybe Tom Brady. You know, he's suspended, right, Daniel? So Eli Manning, you can think of him, and he's a right arm. He has a right arm throw. And because of his right arm, how talented he is, that's why he gets millions and millions of dollars. Without the right arm, does he get the millions and millions of dollars? No. So what do those people do? He has a specialized insurance policy on his right arm. You don't have to be a professional athlete with an amazing right arm to insure your income. You could do it. You can insure your income. If you knew how to insure your income and you have to spend extra money to do it, wouldn't you want to know? How soon would you want to know? Yesterday, right? I thought you were going to say right now, but I like yesterday better. So that's EPP. Everybody's down with EPP, right?
Yeah.
Insured property protection. Number 5. Rena, what's number 5? That's BLT, right? Not bacon, lettuce, tomato. It's build long-term savings. So tonight you're going to be coached by a lot of people. Not a lot, just a few. And we coach people not only in their lives, their finances, and their thinking too. And I encourage you to shift your thinking in one way. And this is this. When you get paid every month or every 2 weeks, the first output, you take that money in, what's the first output? It's to pay your, well, that's what it should be. For most people, what is it though? They pay the bills. Make sure that everything in our lives stays, the electricity stays on, right? Make sure the internet stays on. Make sure the house, air conditioning. Hey, you gotta have air conditioning, don't you? So everybody pays somebody else first. We coach folks to reverse that thinking and pay yourself first, because is the AC company or the car insurance company going to pay you later in life when you need it? No, they're not going to pay you. So reverse your thinking. I'm not saying be an extremist and live off the grid. No. Maintain the things you have. Think differently though. Pay yourself first, because only you can take care of you later, right? Anybody want the government to take care of them? That's ridiculous. I was at home working today, and I was watching the daytime, like Maury, and whatever it is. People arguing about like kids and all that stuff, and I couldn't believe it, because I was thinking back to, well, I don't really want to get into this, but parents at my school in Memphis, like they're sitting at home watching that stuff, and the government's allowing it to happen. I can't stand it. I don't want anybody to rely on the government. So anyway, that's BLT, build long-term savings. Anybody disagree that we should have long-term savings, build long-term savings? So pay yourself first so you can have long-term savings. Jesus said, I want short-term savings. I only want it for a little bit.
No, definitely not.
So then we got number 6. I'll read that one. Is preserve your estate. Preserve your estate. Always telling people, I always thought that an estate was just a big house. Anybody else ever think that in your life when you were younger, maybe?
Yeah.
Okay, because you can play a board game like Monopoly or the game of life. And I think they have those houses, and it's like, you want to put an estate here? I always thought it was a house. It's not, though. And it turns out an estate is not always a good thing. Why? Because an estate can be what you owe or what you own. So it could be a debt or a credit, basically, or it could be both. And it depends if you're above the red line or not, whether or not you want to inherit somebody's estate. How many people would want to inherit an estate of someone who had no assets, no debt? You don't want that estate, do you? Nope. But we all want somebody's estate like Bill Gates, right? You want his estate, lots of cash. So we coach people to preserve your estate. Make sure you know the affairs of your life, your loved one's life. Don't rely on a lawyer or a judge when it comes time to go to heaven to tell you what's yours, what goes to the government, what goes to your sister and your uncle you didn't even know you had, and then what goes to the lawyer. Don't deal with that stuff. Preserve your estate. Be the manager of your life. And if you have a family, be the manager of your family's lives until they can manage on their own. So preserve your estate. So what are we, and how do we capitalize and insure all these things for people? Every one of them we cover in just 2 services. We'll cover them all tonight. But first, I want to introduce you to who we are and what we do. I mentioned earlier, we brand ourselves as a consumer advocacy group. So we advocate for consumers. And we just bring in this magazine to give you an idea of what that means. Anybody ever read this magazine before or seen it? Had it mailed to your house maybe? Cool. Well, it's Consumer Reports. And it's great because a different issue comes out every month, and they specialize in covering products for consumers. They're a nonprofit organization. So they're not in partnership with the company that sells the toaster or the car. They're nonprofit, non-biased. So they provide you with their best research and surveys to tell you what's the best for your money. So you can find out what's the fastest, slowest, best value, cheapest. Cool, right? Well, we liken ourselves to a consumer advocacy group because the world of finance changes all the time, doesn't it? A lot of people don't think so because some people are still operating as if this economy is our grandfather's economy, or as if the stock market is our father's stock market. It's not. In fact, the financial world is a lot like the technology world. You ever gotten a cell phone and then 2 weeks later it's outdated? A month later, the new cell phone's out, the version that you just got, 2.0? Well, the financial world is very, very similar. And that's because it's changed over time. And because of what we know as consumer advocates, we have to shop for what's best for people. So this is what we are. We're Empower, a consumer advocacy company. We're going to go over a lot tonight. So if you have a notepad and pen, take notes because it will be a lot. It will be basic though. We don't expect any of you to have a full understanding, a full education, all of a sudden be an expert, a finance wizard in just 90 minutes. Don't think that should happen to anybody. However, you can maximize what you learned tonight by taking notes. Isn't that true? So, the ink on the paper is going to help you retain this. And we're on a crusade because we see people suffer too often just by leaving a couple of these out of their lives. And so we're on a crusade to make sure that we put a stop to that and we can make a difference in people's lives. We don't get paid in this business unless we make a profound difference in someone's life. Eliminate all the ways they can fail financially or teach them how to make and save money. Right, Drew? You just can't make money unless you can do that for somebody. So, we're going to go ahead and review some strategies with you. How do people like sports? Anybody like sports? Okay. Well, there's a famous football coach named Bear Bryant. You ever heard of Bear Bryant?
Yeah.
What was your name again, sir?
Marcus.
Marcus. So Bear Bryant's a football coach, Marcus. One of the best football coaches of all time in college. And he had a strategy that he used for all of his teams. He won national championships at different schools. And he always said that offense sells tickets. So they score the touchdowns. That's what brings the fans. And defense wins national championships because if the other team can't score, can they win? No, they can't win. So we're going to go ahead and go over the way that we adopt that philosophy. We come from a line of athletes. And so we employ the same strategy that Bear Bryant did on offense and defense. And, of course, the most important one is defense. So let's play a little defense here and go over some of the strategies. With our money, we need to defend against a lot of things. Number one is market loss. How many people have paid attention to the stock market recently? Michelle, didn't you? Yeah. The stock market is like a roller coaster, right? It's like one of those things in the hospital when you're hooked up and it's measuring your heartbeat. Except hopefully it doesn't go under. And yet, a lot of people have their money in it and don't even know it with your 401ks and your IRAs. We defend against market loss to protect our money from the volatility. That's what it's called when it changes all the time, right? The volatility of the market. Get off the roller coaster. So we defend against that. And the second one, fees and commissions. Most people don't know. In fact, I'll just ask, how many fees do you think are appropriate to pay someone for an account that they manage? How many fees do you think are okay with paying?
Only one fee, like, percentage-wise?
Well, just how many different fees? Or a percentage, yeah. One?
I'll say just one.
Just one, right?
Yeah.
That would make sense. One flat fee, wouldn't it? Well, we play defense because, unfortunately, it's not how we think it should be. That's not how our system works. People have 401ks. I had a 401k. I was a teacher for the past 3 years, forced to pay into a 401k. Not my choice, forced. $80 every 2 weeks, $160 every month, out into this managed account where I'm paying not one fee, not two fees, not three fees, between 12 and 17 fees. And if I wanted to find out what they were all for and exactly how many they are and what kind of money that takes out exactly, man, you have to be a full-time researcher because they hide it in something called a prospectus that even a college-educated person like myself doesn't even understand. So fees and commissions we're playing defense against because it eats away at your account. The average fee, research says, is about 3.1%. Over the lifetime of an account, if you do the math, that is devastating. And we'll show you the math on that in a little bit in a video, so you'll see it. And finally, we play defense against taxes. Okay? Now, we love that taxes pay for schools. We love that taxes pay for the roads, don't we? Taxes pay for some things that we don't want to deal with. You don't have to make sure your water's clean, do you? No, I'm glad that I don't have to make sure my water is clean. That's one of the blessings of living in our country, right? Not every country has the same blessing. However, when it comes to your retirement and your long-term savings, if you could opt out of the tax system with your retirement account, wouldn't you do it? How soon would you opt out? Immediately. Well, there's a way to opt out of the tax system completely legally, and you can still feel good because, trust me, you'll still be paying taxes on your income and just about everything else. So you're still contributing to society. We can opt out of taxes in our retirement. We play defense against taxes because just like fees and commissions and market volatility, those things can be devastating to the long-term value of your account. Anybody want to be devastated financially? No. Nobody wants to be devastated in anything. So let's sell the tickets now, right? We play defense so we can win the game, and then offense sells tickets. We want to do things like grow our money. So number one, we play offense and grow our money. We spend so much time, 40 hours a week, 60 hours a week, busting our butt to make the money, don't we? Sweat equity is what I call it, because you're pouring the sweat to get the money. Most people are so occupied earning the money, they have no endurance left to find out what's happening to it or to care about advancing what happens to it and be the most efficient and smart with it. Well, you're working so hard for your money, wouldn't you want your money to work hard for you also? So you want to grow it. And remember, we're still playing defense, so let's grow it and not be on the roller coaster. Okay? Teach you more about that tonight too. Also, we're playing offense because we need to make income. That's the whole basis of this. You have to have income to get growth, don't you? You got to have some place to start. So we'll ask you tonight if you could use an extra $500 to $2,000 a month in your pocket. Would you want to know how to do it? That's a perfect opportunity for income. Let's play more offense. Safety. How many people have heard someone or thought in your life that if you want growth, you have to risk? You've thought that before, right?
Yeah.
I always thought that. In the stock market, I want to get 25%. Well, most people feel like you have to be prepared to risk, don't you? Well, one of the ways that we're strategizing is to provide safety along with the growth. And finally, we want liquidity. I always thought liquidity had to do with like water, right? In science class, how many people did the oil and water in a water bottle? Right, the vegetable oil? I thought that was like liquidity. Liquidity is not a science experiment. Liquidity is access to cash. And if you have a qualified fund that your employer hooked you up with or that you just went out and got, you don't have liquidity. I didn't have liquidity with my teacher mandated 401k. I'm pulling it out now. I told some of y'all last week that they want 20% of my entire value just because I want it now. If I want to take it out on their terms, then they won't take that 20%. I'll have to wait till I'm 59 and a half though. And by that time, inflation will kick in and that money will be worth nothing anyway. I want it now and they're trying to hold it back, tax you, penalize you. That's how it works with qualified accounts. We play offense, so we have liquidity. We don't want to have to ask anybody permission for our money without paying for it. It's unbelievable. And finally, tax efficiency, like we mentioned. If you could opt out of the tax system for your retirement, how soon would you want to know how to do it? So we're going to show you how we prove it. Everything I said, believe it or not, we back it up with math and numbers because numbers don't lie, do they? People do. And so we're going to prove it with numbers. And to do that, we're going to bring up a scientist who's going to show you a calculation and some numbers. Awesome, entertaining every time. And that's the VP of our company, Ryan Young. Give a round of applause.
Thank you. So Shane talked about some great and important stuff there. 6 steps of financial security. Of course, we need to make sure we don't have to switch cheese finance because the holes in our financial plan is what's going to cause all the water to leak out. And we don't want that to happen. The hole in the bucket, we got to plug it up. So then we got to keep in mind offense and defense also. But if we don't know the rules of the game in the first place, we can't play at all. Is that right, dude?
That's right.
All right, cool. So what we're going to do now is go over the rules of the money game, how it even works. How does it break down? And, okay, so anybody recognize this guy here? Einstein, pretty smart dude, I guess. Yeah, I'd say so. And a great mustache, by the way. They're coming back. So I can't even grow one, so I'm working on it. Daily whiskey supplements, yeah. Okay, so he said, this is called the Rule of 72. And he came up with this mathematical equation and said that it was the greatest mathematical discovery of all time. And he came up with the theory of relativity also, which governs physics as we know it. So if he's saying that about this rule, then you better believe it's pretty important. Would you agree? Yeah? All right. So go ahead, Shane. What this rule says is how money doubles using compounding interest. So you always hear about interest and compounding and all that, but how does it actually work? Most people couldn't tell you that. And this is it. And I learned this in the 4th grade, so it's not that complicated. I learned it with jelly beans, which made it a little more fun. But we'll go through it right now. And what you do for the equation is you take 72, you divide 72 by whatever interest rate you're earning on your money. So if you're earning 1% interest on your money, 72 divided by 1 is what? 72, right? So it takes 72 years for your money to double on itself just once. Does anybody want 1%? No, a little faster than that, right? All right, so we're gonna run through an example. Now, I'm gonna do something great for you guys. You're all 23 right now. Turn back the clock. We're all 23, and you have $5,000 that you gotta put in the bank somewhere, right? Because where do people go when they get a paycheck? Where does it go? Direct deposit. Direct deposit into the, thank you, the bank, right? That's what we're all doing. So, Boga Boga, you're all 23, and what I'm going to do today in the Bank of Ryan is give you the deal of a lifetime. I'm going to give you a free set of scuba diving gear. That's for you, Kev. With the opening of a bank account, a deposit of your own $5,000. It's a pretty good deal, right? Would you come to my bank? Marcus, would you come to my bank?
Yes.
Yes? Are you a diver?
Yes.
You are a diver. All right, cool. So you got a brand new set of scuba gear. Great. So you're 23 years old, you're coming to my bank with 5,000. 72, I'm going to give you 2% on your money. So does anybody know what bank accounts are paying right now on savings accounts?
Less than 1.
Oh, yeah, it's like 0.02. So I'm going to give you 100 times more than that, plus the scuba gear, just for coming to my bank. So we're all still on board with the Bank of Ryan, right?
Yep.
Okay, good. Great place to be. So 72 divided by 2 is 36. So your money's going to double on itself every 36 years, right? So get that to 23, 59, 95. Hopefully we're not pushing up daisies by then. You'll have $20,000 in the bank. That's how the Rule 72 works. It's 36 years after 23 is 59. 36 years later is 95. So Kev, what will you do with $20,000 when you're 95 years old?
Not much.
Not much. And think about this, right? 70 years ago, how much did a new car cost?
About 4,000.
Yeah, or less probably. And now what do they cost? About 30, 38, I think is the average brand new car cost. So inflation is a factor too. So 70 years from now, you got to think, what am I going to get with $20,000? Probably, lunch one day. One lunch, that's it. Because inflation is going to take place, and $20,000 won't be worth very much. So we say woohoo to that, and there's some sarcasm built into this. So we're going to make the deal even sweeter here. Go ahead, Shane. So 72, I'm going to give you 6% now and the scuba gear. So 6% means 72 divided by 6 is every 12 years. So your money's going to double on itself after every 12 years. So if you're the same 23-year-old, the same $5,000, Marcus, what are you going to have at 95 years old? Take a guess. If you had, so this is all I did. All I did was I took 2% and I tripled it. I tripled the interest rate, and I cut the doubling time down into 1/3 of what it was. So I went from 36 years to just 12 years. So if you had 20,000,
I said at least 60,000.
at least 60,000, all right? Kev, what do you got?
About 60, 70,000.
60, 70, all right, I'll pick on you guys because you're a new guest tonight. So I'm going to make a deal here, and this is because I'm the bank and I make the rules. You get the scuba gear, you get the years back on your life, you're both 23 now, but I get to keep all the change. I'll give you your 60, 70,000 each, and I'm keeping all the change. Okay?
I use it, wait.
I'm sorry, but I'm the bank. It's in the fine print. You had to read it before you open the account. Okay, so let's play it out. Jake. Go all the way to the end for me. Every 12 years, you go down. When you get to 95, we're at $320,000. Not quite what you expected, right? It's a little bit different. So literally what we did is for brand new scuba gear, you just paid me about $260,000. Is there any scuba gear that's worth $260,000?
Gold plated.
You probably get a whole submarine or something for that much. Yeah, with a pet shark. Comes with it, right? So yeah, yeah, right. That's crazy. That's totally insane right there. So that everybody says the same thing too, probably 60,000 because I'm tripling the interest rate, but this is how compounding interest works. So now I'm going to go one more time for you. I'm going to make the deal even sweeter. I'm going to give you 8% on your money instead of 6. So this time I'm only increasing the interest rate by 2 points and cutting the doubling time down by just 3 years. So Kev, what's your guess? If you had $320,000 here at 95, what are you going to have at 95 at 8%? Only 2 percentage points and 3 years less.
Probably about $1 million.
About $1 million? Okay. What do you got, Marcus?
700,000.
700,000?
Yeah.
Okay. So here's the deal. I'm going to give you the scuba suit, any flavor of lollipop that you want, and I'm going to keep all the change. You get the money you want. I'm the bank. I make the rules. Sorry, guys. So, all right, Shane, go for it. Okay, we go all the way out. Now, I would say that you weren't far off with $1 million, but we're at 1.28 million, so you still paid me $280,000 for a scuba suit. That's kind of an expensive scuba suit. So this is how the Rule 72 works. Now, let's put it back into perspective. This is just the math behind how interest works and money grows on itself. So look at what we got over here. This is A right here, right? And this is B over here. First of all, which one would you rather? A over here or B over there? B. Right, it's almost a rhetorical question, isn't it? You'd be nuts to choose A. But what are most people doing? That. So when people, they build 4 walls, right? And they slap bank on the front, and then everybody goes and puts their money in the bank. Some people put it under their mattress, which is not paying 0.02%, it's paying nothing. So, you know, this is what's happening. People put their money in the bank, and the bank's going to say, when you're 95 years old, we're going to give you $20,000. And in reality, it's much less than that. What do you think the banks are doing with that money that you just lent them? Laughing at you while they go all the way to B. They don't have to run to the bank because they are the bank. So B, and how are they doing that? You know, and how is that okay? Is it morally even correct to give somebody in their family $20,000 and keep 1.26 million that could belong to them? I mean, I'm not okay with that. That really ticks me off a whole lot. So and that's why I'm in this room right now, because of this right here. And we call that legalized extortion. Because why would anybody do that if they knew any better? The fact that it's legal is because we're walking through the doors and handing them all our money. And how are they even making that money? Does anybody have a credit card in here? Yep. And throw out some percentage rates for me on credit cards. Like there's 18, 17, 27, 22.4. They go all the way up to 33%. So think about the Rule 72 now. 72 divided by 33 is what? Just over 2, right? So the credit card companies, which are the banks, are doubling their money every 2 years on all our money. And whose money are they lending you while you use a credit card? All the money that's deposited in the bank. Then if you want to go get a house or a home, you know, the American dream, white picket fence. When you want to do that, where do you think they're getting the money to lend you? They're using all of our money to make the Rule 72 work for them instead of us. And they're not telling you this stuff. Why would they? That's how they make their money. If you go to a big city and you look up the buildings, what do they say on all of them? Banks, mortgage companies, insurance companies, every single one, all the sports stadiums. Think about it. We are building those, right? From maybe individually. You know, that's an expensive. I'm selling scuba gear for you know, $260,000 per set. I'm doing pretty well for myself, right? So I'd say so. So this is absurd and not okay. Not at all. So we got to figure out how to stop making the Rule 72 work for everybody else, all the banks and the big companies, and start putting the ball back in our court, right? Make Rule 72 work for us instead, because we want to take advantage of both of the offensive strategy while we have in place the defensive strategy, right? So what we'll do now is show you a quick video. It's about debt. Because if they're doubling their money every 2 years on credit cards, and if you're late by a day charging you $35, you know, that's a whole nother gain off of nothing they're getting. We need to figure out how to stop that for people. And this is the first step. It's a short video, and it's all about debt. So we'll play this real quick, and then we'll turn it around and show everybody how we can make the Rule 72 work for us instead of everybody else. So here it goes. If I can find the mouse. Here we go. Loading up. Yep. Should be good.
Did you know that millions of Americans are overpaying their mortgages? And not by a little, by tens of thousands, even hundreds of thousands of dollars. That's right, and it's all in interest payments. The fact is, most Americans could be living the lives they've always dreamed of if they weren't spending the majority of their adult lives paying for the lives their lenders have dreamed of. In this video, we're going to show you how overpaying your mortgage is robbing you of the future you could have, and what you can do to stop paying for somebody else's dream and start turning your financial dreams into reality. So let's get started. Meet Bob and Katie Smith. The Smiths own their own home, and they're in a pretty typical mortgage situation for millions of homeowners across the U.S. Your individual mortgage details may differ from this example, but the financial principles remain the same. Bob and Katie have a 30-year mortgage for $200,000 at a 4.5% interest rate and a monthly payment of just over $1,000 per month. Bob feels like they're pretty lucky to get a 4.5% rate. I mean, that's a great deal, isn't it? Well, to answer that, let's take a closer look at that 4.5% interest rate. How much of the Smiths' payment every month is going toward interest, and how much is going toward principal? By the end of the first year, they've paid their lender more than $12,000. Of that, nearly $9,000 went toward interest. That means that over 73% of the money Bob and Katie paid their lender in year one went toward nothing but interest. That's 73% of their payments up in smoke. And in year two, it doesn't look much better. Once again, Bob and Katie paid their lender over $12,000. And of that, more than $8,700 went toward paying interest. That means that in year two, over 72% of the Smiths' money went toward nothing but interest. Now let's fast forward to year 20. By year 20, Bob and Katie have paid over $243,000, but they still owe their lender over $97,000 in principal on their loan. That means that after paying all that money, the Smiths still owe almost half the original amount they borrowed. And by year 30, the amount Bob and Katie have paid their lender totals almost $365,000, of which nearly $165,000 went toward paying nothing but interest. That means that they've paid their lender over 82% of the amount they originally borrowed just in interest payments. That's 82%. Quite a far cry from the warm and fuzzy feeling the Smiths had when they heard they got a 4.5% loan. So where do all the billions and billions of dollars homeowners are paying the banks in interest go? Exactly. Homeowners like Bob and Katie from all across the nation spend their lives making interest payments to the banks and wonder why they never get ahead. But guess what? It doesn't have to be this way anymore. What would you say if someone told you that there is a simple online banking solution helping homeowners like you put an average of 18 years or more worth of mortgage payments back in their own pocket? How excited do you think people like Bob and Katie would be if instead of having to pay the bank over $164,000 in interest payments, they could pay less than $63,000? the same amount of interest they would pay if they had just a 1.9% fixed rate on their mortgage. That's nearly $102,000 in interest payments they would save. And their house would be paid off free and clear in just 12 years versus 30. Thanks to our online banking solution, Bob and Katie would be done making mortgage payments in just 12 years. What could you do with over 18 years of mortgage payments you no longer had to pay to the bank? Just imagine the possibilities. And you don't have to refinance. You don't have to change banks. You don't have to increase your minimum monthly payment. And you don't have to modify your mortgage or change your mortgage terms in any way. Just imagine the freedom you would have if you no longer had to make mortgage payments to anyone. Don't waste another minute. Watch the corresponding overview video right now to get a thorough look at how this looks.
Okay. So we said debt's a drag, right? Now that's pretty shocking also, right? How many people actually know that when they get a home, they're paying for 2 or 3 houses? Because why? It's stretched out over 30 years, right? In what world is it right to think it's okay to pay for something for 30 years? You know, that's kind of crazy, right? But that's our conventional knowledge right now. That's what we know, and that's the way we know how to do things. So rather than making the Rule 72 work for the banks that entire stretch of time, what we've come up with and what this is, it's really a GPS system for your own financial life. So, you know, when you're going anywhere in your car and you don't know the directions, what do? You plug it into a GPS, right? And it's going to tell you exactly where to go and what turns to make and get you from where you are to where you need to be, right? And if you go the wrong way, what does it do? Reroutes you, right? Recalculates. And then it tells you how to get right back to where you need to be in order to get to your destination as quickly and efficiently as possible. And that's exactly what we've developed over years and years through mathematical algorithms, a GPS system for your financial life. And what it's able to do is pay off somebody's home without changing their budget by a dime in 1/3 of the time that they would have otherwise, which is pretty remarkable. And the math behind it is very interesting. And, you know, having a science background in statistics, I've looked into it and I know that it works. And I've had recently, just for an example, some of our clients had a 30-year mortgage that they just started, and their home's going to be paid off in 6.3 years. And they're going to end up saving $154,000 worth of interest payments that would have gone otherwise to the bank. What could you do with not only $154,000 that's no longer going out the door, but 24 years that you would have been paying for that home? All that money can then do what? Go back into your pocket. What was that? Go on vacation. Establish an emergency account. Ensure proper protection. Build long-term savings. All that good stuff. End the vacation first.
Pay yourself first.
But it's all those things that we're limited. You know, Swiss cheese finance happens when we're limited in certain ways. And this is a big one. So, Kev, you're getting your real estate license, right? So you're, without really knowing it, I mean, you do know, you're putting somebody in more debt than they've ever been in their entire life, right? If you knew of a way to help them get out of that debt, would you want to also provide that for them?
Oh, yeah, I'm still getting the same.
right? Why not help somebody if you could, right? And then possibly get paid more. I'll tell you that in a little bit. So we're gonna, and that, just so you know, this doesn't just work with mortgages, it works with every kind of debt possible. Credit cards, student loans, medical bills, car payments, whatever you got, it's gonna take it and teach you how to get out of that debt in the fastest, most efficient way possible, saving tons and tons of interest. And the part I like most about it is that it takes all the manual labor out of it. It literally tells you what to do every single day and automatically updates when you swipe a credit card or when you pay for anything. It's gonna say, oh, because you bought that cheesecake at the Cheesecake Factory, now you just added a month to your entire debt structure, but this is how you get back to where you're supposed to be. It changes everything just based on the swipe of credit card or whatever. So very powerful in time savings, just in daily calculations and the long run too. So then what do we got to do? We got to take that money that we're saving and make it work for us now so that we can grow our money to be able to provide an income so that we can, and keep it safe, make it liquid, and then we can retire on it one day, right? Because we don't know when we're going to have to retire. It might be when we want to retire or when we have to. We don't know that, right? A lot of people don't think about retiring out of necessity. That's something that nobody thinks about. So we're going to show you one more video. It's about 3 minutes long. That gives you an introduction to where to go to accomplish the 6 steps and the offensive and defensive strategy. Yeah.
Hey, thanks for joining me here. I wanted to give you a quick snapshot on what it is that we're doing. This is a snapshot of our program, Red Line, Blue Line. Not knowing anything about anything, if you had to choose one of these 2 lines to put your money on, would you choose the red line or the blue line? The blue line, of course, right? Because it's more money. If you look closer, what you realize too is that it never goes down. It only goes up. Never go backwards. Gains are locked in. But you know, the story gets better than that. In addition, that $211,000 is income tax free. The red line is the Standard & Poor's 500 index. That's the stock market. 500 of the largest stocks in America. And if you look at this 165, about 95% of mutual funds do not outperform the Standard & Poor's 500 index, meaning that most people in mutual funds, 401ks, IRAs, so on, actually had less money than the 165. But we still have to deduct fees because fees didn't come out of this. The average fee is about 3%, can be anywhere between 1.5% to as much as 5%. Many people aren't even aware that they're paying these fees because they're hidden in what looks like a phone book of written by a Philadelphia lawyer called a prospectus. But when they examine that, the Los Angeles Times said the average is about 3%. And in this case, on $100,000, that would be about $3,000 a year in expenses that you have to pay, by the way, whether you make money or lose money. And if we just roughed the numbers out and said $3,000 on $100,000 over 15 years, means you'd have to subtract $45,000 out of this number. But we still have to take taxes out. And if you even looked at a 10% or 15%, 20% tax bracket, you know, very conservatively, you're about where you started 15 years earlier. Now, you put up 100% of the money, took 100% of the risk, and ended up about where you started 15 years later. I want you to think about this. The mutual fund company put up zero money, took zero risk, and they made $45,000 in the process. $17 trillion today is on the red line in qualified plans. That's 17 trillion with a T. Without anyone spending one additional dollar, don't you think that most people would prefer to be on the blue line? In addition, this comes with all sorts of other benefits. This is net of fees, charges, expenses, and it's also income tax free. So here we have a smarter, more complete alternative to 403b, 401k, IRA, mutual funds, to the stock market, where you don't have the risk. By the way, that $211,000 is guaranteed never to be less than that. It can only go up, never go down. In addition, there's other benefits that come along with it. When you look at the whole package, it's, again, a no-brainer.
Just play this presentation for me and go to the red line, blue line. So if you had your choice, which one would you choose, red or blue line? Blue, right? That's another almost rhetorical question because number one, it doesn't lose money. Number two, it grows tax deferred and it pulls out tax free. And you're still taking advantage of market rates of return without having any risk. So, can you bring that up for me?
I have it up here.
You might have to drag it over. So the red line, that's the S&P 500, right? You guys familiar with the S&P 500? Top 500 companies in the country and the main barometer for our economy right now today. So it's going like this, right? And what did it just do last week? Big time crash, right? And today, yep. All the gains that we had for the last 2 years are now gone forever. They're never coming back. And in a strong bull market, if it took 2 years to get from that spot to where we were, How long do you think it's going to take even to get back to break even again? A long, long time, right? That example is over 15 years, starting at one point, then your account grows a little bit, but after you take fees out and then you pay the taxes, you're right back where you started anyway. So now we're 2 years behind the mark just in terms of market loss. We're not talking about fees or taxes yet at all. So where are we really? We're way behind the 8 ball. Imagine somebody who's 57 years old right now, approaching retirement, knocking on the door, and they just lost 15% of their entire life savings over the past 2 weeks. What happened in 2008? 40% of somebody's life savings in a matter of a couple weeks, right? And we're not done yet. The show's not over. We're on the fun part of the roller coaster, right? All the way down to the bottom. So when your gut goes up into your throat. And that's what's happening to everybody right now. They're in big, big trouble. So what are we out here to do? We're out here to protect and save people from riding this roller coaster and ending up right where they started and not being able to retire ever. That's a scary thought, right? That's what we want. That's our goal in life, is to get the white picket fence house and eventually live a good life. And that's what we want. So that's what we're doing. So what is this blue line anyway? Can you click, Shane? This blue line is, we say tools for modern day personal finance, new technology in the financial sector. And that's really what it is. It's not that old. I'm going to tell you what it is, why, and how it even came about into existence. So first of all, it's called Index Universal Life. Now, nobody likes to talk about life insurance, and we're using it for one particular reason, and I'll tell you why. Actually, several. So what that provides you, this is the blue line right here, provides you with life insurance, living benefits, which everybody needs, not even a question. We'll talk about that in a little bit. Tax-free retirement, that's the last thing. So what does this defend against? Everything we already talked about, right? It rings very familiar for our defensive strategy. So defend against market loss, high commissions and fees, tax loss, declining health, and critical chronic and terminal illness. There's the EPP we were talking about. And also estate tax, passing on to beneficiaries free of estate probate tax. So those are some of the things that it does. And how does this even exist? That's the real question. So go for it, Shane. Because it almost seems too good to be true with all those benefits. And what's really too good to be true is that we've never heard about it and don't really know what it is or how it works, because nobody came to tell us. So that's what we're here for. The history of the IUL: in the 1950s, the tax code was written. Has anybody here read the tax code ever? No. No. Why not, Drew?
Because it's over 90,000 pages.
93,000 pages long. So, some weekend reading material? I don't think so. This is, you'd have to have a ladder even to open the book at all. So that's kind of dangerous even. It could fall on you. So nobody's read the tax code. most people are killed by the tax code. Not physically, but in every other way possible. So even your accountants, your CPAs, your financial professionals, they haven't read the tax code. We actually had an accountant in here. He just took his exam to become a CPA, right? A full-out accountant. And he's like, no, I never read the tax code. You crazy? That thing's way too long. Nobody's read that thing. So an accountant is saying that nobody's read it. So we got to figure out what is in there that we can use to our advantage. And there's 2 rules in there, and you can take note of this. It's rules 101 and 7702. Those are the specific codes that we use. And what that says is that so long as your funds are wrapped around a life insurance policy to a certain ratio, then you can grow your money tax deferred and pull it all tax free. That's a powerful thing. Opting out of traditional taxes that most people pay, using the tax code itself. Most people don't know how to do that. And it's actually very simple. It's just that we have to be educated about it. Second thing that happened was in 1976, a guy by the name of John Bogle, who's one of the top investor guys ever. He started the Vanguard funds, if you ever heard of those. And he invented what's called indexing. Indexing is a strategy of investment that, I'll just cut to the chase. I actually found papers that describe this. It beats every other strategy of investing 92% of the time. Just because that's what stats say. Because like he said in Red Line, Blue Line, 97% of mutual funds don't even hit the average of what the S&P 500 is doing. They're below it. What indexing says is that you spread out. Bogle thought all these investor guys buying and selling and trying to beat the market were crazy. He bought across the board, same dollar amount, sat on it for a year, and in the end, beat all of them, 9 out of 10. So if you were in a casino and there were slot machines, and one said this was a 92% win ratio, the other ones didn't say anything, which one are we going to sit at? Right, it wouldn't make any sense to sit anywhere else, right? So that's what indexing is, and we use that, and it's a very powerful strategy. So the next thing, in 1999, there was a law passed called the Financial Modernization Act. Before that, you may have heard it, there's been articles here and there popping up describing it, the Glass-Steagall Act. That was in place before financial modernization. What that said was banks could only do banking, brokers could only do stocks, bonds, mutual funds, securities, insurance companies could only do insurance. So that was Glass-Steagall. In 99, they put Financial Modernization Act in place, which repealed Glass-Steagall and said, okay, banks, insurance companies, and brokers, you used to be separated, don't cross the streams. Now you can go compete. That's why you can go to a bank and get life insurance, or you can go to a broker and get a banking type account. Things like that now, because competition exists and competition is good for the consumer, right? So out of those three, who won? Banks, insurance companies, or brokers? What do you think, Kev?
Insurance company.
Insurance companies, why do you say that?
Because everybody needs it.
Because everybody needs it, right? And you're exactly right, you hit the nail on the head. Because they have more money than anybody else. 85% of the global wealth is held with insurance companies. Because the banks, the money in the bank is what? It's insured. The building that holds the money is what? It's insured. You know, people buy insurance on everything. And it's risk management, right? So you don't necessarily ever get paid from insurance. Like, how many years have you been driving, Marcus? A long time?
30 years.
30 years?
Yes.
And how many times how many accidents have you been in?
Only once.
Only once? And was it your fault?
No, it wasn't my fault.
So let me get this straight. You've been paying car insurance for 30 years and never used it even one time.
That's correct.
That's okay. So can we see how insurance companies are so wealthy? Right. Because that was a perfect example. Thank you.
Of course, we use it, they tax the rate.
Yeah, of course. So they're making money no matter what. It's built into the cost of risk management. So because they're so powerful, they can provide guarantees that other people can't. Banks can't, brokers can't. So that's how this got invented, because when competition comes, now insurance companies can offer investment type accounts and banking type accounts, just like the others can offer life insurance. So what happened in 2000, they developed what's called the IUL. And then by 2004, they worked out all the kinks. Anytime new technology comes out, it's got bugs in it, right? So they ironed those out by 2004, and it's been great since then, and even improved again in 2015, giving more growth potential for people. So this is relatively new. So people that are in life insurance, people that are in investments, people that are accountants, they don't even know that this exists. They don't know that this is an option for people. I even took an insurance course, my licensing course. The instructor, when I asked him further questions about IULs and how they work, said, that's some new kind of thing. I don't really know about that. You can look it up on your own, though. There's no questions on the test about it. That's what he said. So if the instructor of the course doesn't know what this is, I can pretty much assume that most others don't either. And that's why we're here right now, because if we can provide market rates of return without risk, tax-deferred growth with tax-free withdrawal, and be able to take advantage of the growth without risking any of it, that's absurd. That's something that everybody needs to know about. There's another thing that everybody needs to know about too, which is relatively new, and that's living benefits. Everybody needs living benefits. And for that, I'm going to bring up a next speaker, and that's Andrew Cancel. Thank you, Andrew.
Okay, living benefits. In my opinion, living benefits is the most important part of an IUL. Can anybody guess why? Marcus, why do you think living benefits is the most important part of an IUL?
I would like to learn.
Because 7 out of 10 people will have either a heart attack, stroke, or cancer before they even reach retirement. So if you make it to retirement and beat those odds, then you're in good favor. But 7 out of 10 people, 70%, whoa. So what living benefits is what in the industry is known as accelerated death benefit, and there's a whole bunch of different add-ons that equal living benefits, but we work with the companies that add it as a no-cost rider. And what living benefits is, if you have any of those big three, heart attack, stroke, or cancer, or any of the 16 triggers, ALS, diabetes, AIDS, HIV, you lose an arm, you lose a leg, you lose half of your face. Living benefits will advance you up to 90% of your death benefit. And living benefits was actually started by 2 surgeons from South Africa, the Bernard brothers. And they were the first ones to successfully do a major organ transplant. And one of their patients had died because even though the medical facilities, the hospitals, the doctors were getting paid through health insurance, no one was able to pay that person's income. So the woman had to go back to work and eventually died. So because they had such great pull with the insurance companies in Europe, insurance companies is what you considered a legal reserve. That means that whenever you have a policy, let's say your policy is a $200,000 death benefit, they need to have that amount 103% in an account connected to you because they have to be able to pay that out. So when you sign your name on a dotted line, that money's already there. The Bernard brothers basically went to the insurance company and says, why can't we get this money for the people when they need it the most? And that's exactly what that's exactly what living benefits is. How many people, by a show of hands, knows anyone that's had either a heart attack, stroke, or cancer before the age of 65 and survived? That's pretty much everybody in the room. And it's something that has affected us all. My mother, when I was in high school, was diagnosed with breast cancer. And living benefits could have been something that could have changed her life, because even though financially both of my parents worked and they were professionals, and I'm pretty sure they had an emergency account and 6 months to a year's worth of insurance. It would have given her, finances. It would have given her that peace of mind to know that she didn't have to go to work because the income would have still came in. So that's something that we all need. That's one of our main crusades. This is something that every American needs, because what living benefits ultimately is, it's income protection. And everyone has an income to survive. Everyone needs an income to survive. And that's the most valuable asset we have. We insure our phones, we insure our laptops, we insure our electronics. I bought a video game a couple weeks ago. They wanted me to insure that. They asked me, for another $35, do you want the protection plan for 4 years? No, I'm good. But I do want the protection plan of my income, because if anything happens to my income, I'm a barber by trade. I'm not going to be a barber too long, but if anything happens to my arm, my left arm, because I'm a lefty and I can no longer cut hair and I lose an arm, or I can no longer stand on my 2 feet, I'm one move away from a major mishap. And most Americans are like that because they don't have these steps. They don't have the emergency account. They don't have long-term savings. Something like living benefits, a $500,000 death benefit, 90% of that, that's more than a year or 6 months worth of your income. So that's what living benefits is. And, the stats let you know, 78% of these people that had that big 3 before 65, they all had health insurance. Does anybody know the average age of a heart attack in America? Actually 42. And the average age for bankruptcy is 43 because of that fact right there. They have health insurance, but they don't have any income protection. The lives that we could affect with living benefits is tremendous because everybody and anybody needs it. So that's pretty much living benefits. And are there any questions or? Okay, I'll bring up, are you coming, Coach Young? Our next speaker, Coach Young.
Thanks, Andrew. Well, good morning.
Morning.
Okay, wake up now. Big Kevin, you awake? You underwater there, Kevin? Marcos, did you learn something?
I have so far.
A lot, okay? Now, I got to tell you something. I'm sitting over there listening, and Danny, I don't know what you got, but first of all, here's what I got, Nicole. Shane's very likable. Ryan's very likable. Drew, no, he's very likable, okay? And what they did was line up, and they presented very well. In fact, I got to tell you something. If I was sitting here for the first time, we'll talk. You got to get active, or I'm going to have to put another boot on your other leg. Okay, good. That was a polite threat. How was that? You like that, Jesus? So listen up, okay? your stories were great, and I'm just listening to how you present. It's all common sense, and I hope, Daniel, that you're gonna do this next week. You're gonna start speaking like that, Rain. You gotta do it, okay? I mean, I call everybody a different name all the time. So, I got a lot of names for you. So the bottom line to it is, it's great to be friendly, great to be nice here. We're gonna be very abrupt. That makes all the sense in the world. Right there, you should have all been closed. And here's the problem. People come here every week, Kevin, they learn what you just learned, and they walk out of here and don't take action. And then they complain, bitch, and moan and groan about how life is treating them and how much money they don't have. It's unacceptable. It's unacceptable to live life and keep doing the same thing over and over and over again and expect different results. They say that's the definition of insanity. And there's a lot of insane people in this world. Am I right or right? And you're creatures of habit. And none of the habits that you're doing are enhancing your life. So fix it. Now, here, I don't put up with it. I'm afraid of change. What? It blows me away. At least you change your underwear, at least some of you, okay? Now, here's the deal, okay? You got to learn to change and be flexible. And you got to learn the rules. It would blow me away. How many of you, prior to experience with Empower and FEG, never heard of the Rule of 72 before? Okay? Me either. That's what put me in the business. Kevin, you should sit there. And how young are you, Kevin? Yes. So I said, how young are you?
44.
44. Young man. What would your life be like right now if you knew that when you were 18 and started using money the right way? There's no question about that. You see, we saw it when we were 28 years old, and we got ticked off when we sat there, Nicole, and I didn't believe it. I thought it was too good to be true, one of those deals. And we were a consumer advocate by profession, by the way. New York media covered us all the time. That was my story. I said, no way. And I learned about financial services industry. See, if you had said the word financial services to me, but way back when I was early 20s, I'd go, no. See, I thought you had to be a sophisticated Wall Street whiz kid and have to understand all the sophisticated numbers, and I hate that stuff. I don't like math. In fact, I think I failed geometry twice. I'm not real good at it. See, how many of you still use trapezoids? Right? Yeah, you would be. I'm gonna put it on your head. It's a cone head for you, trapezoid. You see, you got to take that crap. Why? I knew I was never going to use an octagon. I never paid attention to it, so I fell asleep during class all the time. Failed it twice. They said, "Young, you can't graduate without passing that." Whoa! I should have taught the class the third time because I was good at it. Okay, but that's the deal. See, it's amazing what they teach. The things you don't know. How many of you use? You got to know about rectangles, triangles, octagons, circles. Bull! That's what geometry is, isn't it? All about the figures and dimensions and crap. Algebra, even that. X, Y, 2, Q. I didn't understand those formulas. I hate that. But I tell you what I'm really good at. Personally, how many of you are good at counting money? That I can do. Well, see, you just lied. You lying dogs. Nicole, you lied. Yeah, you know why you lied? You even lie with a smile. You're horrible. Okay. Okay. Hey, imagine they smile and you go, yeah, they're lying at you. Okay, why did you lie? I didn't really lie. Why? See, what did I just ask you? You responded to. What was my question? Remember what I just said? What? No. What was it again?
Depending on how to count money.
Yeah, you can count money, but they make money work for you. You see, all those big industries are taking advantage of you this whole time. See, we can count it, but we don't make. See, you're taught how to go work for money. Marcus, we want you to have money work for you. That's a little switch, isn't it? And all the big corporations do this to you. They put the thumb on you. Kevin, are you told what time to go to work? Uh-huh. Do you go religiously? You punch the clock?
Not really, but
All right.
put it in the time sheet.
Do you drive the same way every day?
Pretty much.
Uh-huh. Marcus, do you do the same thing?
Same routine.
Same routine. Day in and day out. Gets kind of old, doesn't it?
Yeah.
See, we're not old. We're excited because everybody's different. Here's what we don't tolerate. We don't tolerate ignorance anymore. Ignorance doesn't mean we're dumb or stupid. Ignorance means we haven't been informed. However, once you've been informed, how many of you have to take responsibility for your own actions? Okay, and then if you don't fix it, what's that make you? Okay, right. I call it stupid. And guess what you can't fix? Stupid. Now, if I insulted you politely, I meant to. Okay, now here's the deal, because you say, I'm not stupid. If you leave here and don't fix your circumstances, I beg to differ with you. Amen. See, the truth is very bold, Marcus, isn't it? Very bold, and you never have to defend the truth. Ever. As a matter of fact, guess what I did today? This is a big deal. You ready, Hobbit?
I'm ready.
You saw your part. 7 out of 10 people, are in trouble. That means 8 of you in here are in trouble. 8 of you in this room are going to have a heart attack, stroke, or some form of cancer before you're 65. I've already had 2 stents put in my heart. Today, I went for a stress test. You know why? Because I had 2 stents put in my heart. Rena, I don't need life insurance. I've been blessed. Okay, I didn't want life insurance. In fact, why they call that's the first lie. It's not life insurance. It's death insurance.
Death assurance.
Yeah, you bet. Okay, so now we can call it life insurance because you can live and benefit. Everybody, am I making sense?
Yep.
So I didn't have to have life insurance, Marcus, for any reason. And yet I was blessed because we made a lot of money. However, guess what? Living benefits is pretty new. How stupid would it be for me now? And I'm going to be 62 years of age. So, I wish I was 44. Now, the reason I applied for the policy, because if I become now at 62, what's the likelihood of my body starting to fail? It's much stronger than some of you, much stronger than you, right, Kevin? How old are you, Marcus?
45.
40, twins, okay? Now, here's the deal. You're young guys, but I was, 48, 2 stents, in shape, too, by the way. The only way I found it was going up a mountain on a bike. Angina got a hold of me. They call it a silent killer. People that are overweight and don't work out much or don't do anything, they have no idea what's going on inside them. So I had the stents, and I'm telling the story because I applied for life insurance now. Why? Because living benefits only been around for 10 years. If I become disabled now by having a heart attack or stroke or some other thing, I don't want to have to take away from my family. That means I have to go into the assets I already saved to try to keep my butt alive. Am I right or right? I'd rather go buy a life insurance policy now and go take living benefits. It'd be stupid if I did anything else. So guess what? At this old age, I just applied. And the company's willing to underwrite me, but they wanted to rate me table 3. I go, screw you. You know why? Because I work. I'm sorry. Yeah, I did say that. Okay. Tell them the truth again. Oops, right? All right. So here's what we did. We called up and said, no. See, you got to fight. I said, who are you? No offense, my blood, not that you care about it, and urine, the test I took, is better than preferred rate people. Because I'm in condition, I don't even take any medication. I said, explain to me how you can try to get me on a table 3 when I'm better than half the people you underwrite as preferred risk. Answer me that. No, you're a doctor. I don't know a very good one. Answer that. They couldn't answer it. I said, you're messing with me. You're messing with the wrong dude. So they said, well, we'll consider changing it. Well, what happened? Go get a stress test. I was on that stress test today, and I'm a little surprised. Now, I did lots better about 5 years ago on one. But everybody ever do a stress test? You're on that treadmill thing? Here's the deal. I'm going to tell you what they do. They give you 3 minutes, 5 different times, all in succession, okay? And you start out really slow, and then it's a regular walk, then it's a jog, then it's a run, and then it's a sprint. And then they put it on an incline. And I'm going, and I thought, I'll go do, what's the max? 21 minutes. I'm going to do the max. That's what I'm telling them. Well, guess what? At 15 minutes, I go, is there any more time left? And they go, yeah, you got 30 seconds. Good, because I'm done after this. I did the 15 minutes. I go, well, how did we do? He goes, well, you're Superman today. I go, what are you talking about? Nobody else made it. I go, you're kidding me. They told me today, the guys that do all this, do all the tests, that the average person only lasts 6 to 9 minutes. I did 15, okay? But I was shocked that even though I was gasping for air on that because I ride 26 miles on a bike, but when you're running for 3 minutes, sprinting uphill, I'll tell you what, wow. And at my age, and they all do it based on age, so I did pretty good. So guess what they're going to do? They're going to drop my rating now. But I fought it because I'm already issued conditionally. Now I'm fighting for a better rate. That's what we do for the American public. And you can't argue with common sense. So here's the bottom line, and then what we wind up doing for people is making what we call an FIP. Now, it's this simple. I don't want to complicate it. Marcos, you got money in your left pocket? Say yes.
Yes.
He's broke. He needs an opportunity. Can you tell? Right? He's one. He goes, I don't even have pockets. How'd you know, young? I mean, that's why I'm here. Holy smokes, right? Okay, so here's the deal. Marcus, if you got money in your left pocket, what we're gonna tell you and teach you how to do is move it over to the right pocket. Same guy, same money, only when we move it to the right pocket, you're gonna have a heck of a lot more value for it. Would you do that if we taught you that? Done. Kevin, would you do it?
Oh, yeah.
No questions asked. Now, some knuckleheads leave here and don't do it. Ask me if I care.
Do you care?
No. Thank you for asking. I'm not here to save the world. We're here to save one family at a time if they're willing to pay attention and listen. You work too hard. Make time work for you, Nicole. Work smart. And I have no problem challenging anybody. When knuckleheads say no or don't act, man, do I get in their face. You know why? Because we're bold and we're right. And it's always good to be right about something once in your life. And I don't have anybody putting any thumb on me. Nobody controls my life, my time. Marcus, we go fishing tomorrow. How about that? No, I gotta go to work. Come on, Marcus, we're gonna go fishing. See, when you're a slave to somebody else, you can't. I can't stand it. So we make up FIPs. You know what an FIP stands for? Jesus.
Financial independence plan.
Yo hablo inglés? Okay, good. I'm just checking. No, I didn't do anything. So what does the FIP stand for?
Financial independence plan.
Financial independence plan. We believe in two things. What do we believe in, Dan? You know what I'm going for? Two things. You ought to have a debt-free date. If you don't have one, you're not going to get out of debt. Everybody should be debt-free. And there's not too many people in this room that are debt-free. That's a fact. You either own your car, you own a credit card, you own your house. I know it. I get it. We see too many of this. Am I right or right?
Right.
Just checking. I don't like being debt. Did you graduate? Did you have a master's degree?
Yep.
A master's degree to become a biologist for the state of Florida. Tell them the grand total salary they're paying.
Less than $38,000 a year.
He'll make $38,000 a month here. Did you hear that, Marcus? And 2 degrees, a master's degree. Did you graduate with debt?
Nope.
Oh. Ooh. Now you went to college. You have a college degree. Do you have any debt?
I don't.
Yo. How many people can say that? Hardly any. Oh, Kevin can.
I paid mine off.
Right. And he just paid it off yesterday. No, I'm only kidding. No. But
It took 10 years.
boom! Now, imagine you having that 10 years back and having the money work for you. Paying yourself first, Marcos. Did you hear that? How exciting was that? I'll tell you, I'm off topic right now, but I just want to spend a moment if you're paying attention. Years ago, and by the way, we get mentored, are you listening to me? By billionaires. Not millionaires, billionaires. And if it's good enough for them, it's good enough for me, especially when you have integrity. Is that clear? Guys like John Bogle, okay? Guys like Tony Robbins, guys like Warren Buffett, guys like Steve Wynn, guys like Steve Forbes, guys like Art Williams. Art Williams looked me right in the face when I was his age at 28 years old and said, "Are you paying yourself first?" I go, "Hell no, I can't even pay the electric bill myself." He got me so convinced about what I had to do in life that I felt back on, I was dead broke, okay, back in the day. And I was really good for a lot of years. I lost a job, I got laid off, so the company car went, the expense car went, and I was just fumbling around. And I had to go to the landlord, and I had a job offer, but I also saw this business. But this was like, you know, if you don't transact business, you don't eat, right? So that was kind of scary, but that was giving me a cup. But I chose to go for this because I believed the crusade enough. And I had to go, Nicole, to my landlord and said, "Guess what? You either got to throw me out or work with me." "Why? What's the matter?" I go, I'm dead broke. And I learned some new concepts. So I'm going to go for it. I'm going to work. If you work, and I've been there, living there for 8 years already. They go, "We'll work with you. You're doing great." And that was a blessing. Okay, so that was very good to do that. But I went to him and I told him, I said, "By the way, even before I pay you, I'm going to do the rules I'm being taught." What's that? I'm paying myself first. I'm opening up an account and put it away. I've done that ever since. Ever since. And I went from a 900 square foot house in Mine Hill, New Jersey that I leased to a 6,600 square foot house on 13 acres, bought and paid for with cash. Boom! That was cool. How many people think that was a boom?
That was a good one.
That was a good one. Okay, changed our lives forever. All of you should pay yourself first. Would you argue with that? See, the truth is you can't argue with common sense. If you do, you got none of it. And we'll tell you if you don't have it. So everybody needs to have a debt-free date, and everybody ought to have a financial independence date. Marcos, do you have either?
I know.
Yeah, you need it, right? Okay. Kevin?
I'm pretty much debt free.
Okay. When's your financial independence date? Amen. You don't have one. So, and you're not alone. Everybody came in here the same way, including me, right? So this is Ryan's. Now, please listen to this. 9 out of 10 of our people don't spend a dime out of their pocket. How strong is that? Okay? We move money. We find lost money for people. 9 out of 10 people, 0 money out of pocket, moving it from the left to the right pocket. In his case, he's paying $38 a month for this plan, okay? Because he was already doing a lot of the right things. And for $38 a month, here's what he has in his life, okay? On the insurance side of business, he has $350,000 worth of life insurance protection. In living benefits, if he was ever to become sick or disabled and what, he's got the access up to $529,000 for terminal illness up to $600,000. That's pretty good, isn't it, Kevin? Okay, now here's the punch. At 66, until the day he's dead, they will then pay him $103,753 a year tax-free from 66 until the day he's dead. How cool is that when he's been busting his butt making less than $38,000 for the state of Florida, and in his own plan for $38 a month he'll have over $103,000. And by the way, there's only 40% of the United States, 4% of the United States makes more than $100,000 a year. Okay, so already in his retirement program, that's what it does. And this is only one plan he's got. Is this good or great?
Great.
Exactly. Okay, this is what we do for people. So we encourage you to understand our business. We threw too much at you. We understand that. We get that. Okay, but you should examine your own circumstances so you understand it. So we fill out what we call a CNA, confidential needs analysis. Look at your own circumstances, because I dare say to you, if it works for you, it works for everybody. Am I right or right? Right. And I dare say to you, if you're here tonight, you're not making your money maximize at all. And that's what we do. So furthermore, we make an opportunity out of this. Can you bring up that slide? Now, we pay people pretty well. Why do we do that? Because the financial services business is the highest paid industry in the world. So if you're going to do something, if you can do a crusade, Marcus, if you understand our crusade now, do you understand we have several areas of it? See, I love how Shane said that. If you don't have all of these, you have Swiss cheese finance, don't you? Holes in your finance here. See, we make sure everybody has that, okay, based upon the principles that we use. Having said that, just on the financial side of this business, we have a program that can get you to be a VP within 90 days. In fact, Daniel, Nicole, and Rena, you stay behind because I got something to tell you, and you too, okay, after we break. All right, Hobbit, the same thing with yourself. So I got an idea for all of you. You two can leave. No, I'm kidding. Of course you're going to hear it. But now, 65% of the average person is investing $300 a month of lost money that they didn't even know about that we move from people. That's on an average. Everybody clear about that? When you do that, and we get you up in 90 days to be this VP spot, if you go just help 2 people a month, 2 people a month. Did we make sense tonight, Kevin? Okay, watch. That's all we do. We make sense. We just show people A, B. A, this is what you're doing. Same money, same person. B, this is what you can have. Isn't that what we do, Nicole? Pretty good. So watch. When they go from A to B, and you help 2 people a month, show them what they get. Your compensation is $56,000 a year part-time, helping 2 people a month. Do you think, Marcos, you could go out and help 2 people a month? Right. Guess what? If you choose to want to build your own business, we teach you how to do that. You build an agency, just like your mortgage companies, just like your real estate companies, brokers. The problem with the real estate brokers, if I'm the broker you're working with, you're going to get sick and tired of giving me all your fees. You're going to go out and take your broker's test, and I just create a competition. That's dumb. We completely reverse that process here. Okay, we give you incentives. Here's what we do. Marcus, you know enough people, we go sponsor some people. Go put 3 people in your business. These are just levels of management. They do the same thing you just did. They only help 2 people a month. 2 people a month. That's 6 plus your 2. Is that right? That's a total of 8 transactions. Your income just went to $121,000 a year. $121,000 a year. Would that change your life, Marcus? Okay, I don't know how much you want to earn that or how excited you'd be, but that's a lot of money. Rena, we are not working smart enough or aggressive enough to go build your businesses. It's really that simple. Okay, people can say no to all they want. You got to learn how to handle rejection, tell people what you think, shrug it off, and keep moving, especially when you're right. How stupid is it not to advance your financial life for you and the loved ones around you? Am I right or right? See, I'm on a new wave, folks. Okay, I'm coming like a freight train, and I don't care what people think because it's none of my business. I can only control what I think. and what I think right now, unless you can find an argument with, is right. Can you argue with anything we've said, Marcos?
No.
No. Kevin, can you disagree with anything we've said? How powerful is that? I always want to be right about something. So in this business, we're spot on. As soon as I walk out the door, I'm a knucklehead like everybody else. Okay? I don't know anything about anything. But on this thing, we do. And it's powerful, is it not? So I welcome all the new people to go do your own analysis. Look at it for yourself. We do this every Tuesday and Saturday. We do it part-time. We have training like you won't believe, okay? We help you until you tell us, I don't need you anymore. When you don't need us anymore, you're building your own business and company, and we'll help you. And we're looking, I'm gonna tell you what we're doing. We're looking right now for like-minded people because we want to open up several offices in every city in this area. And we've been in the area for about 2 years now, okay? And just starting to get it rocking. In fact, this is the lowest amount of people we've had in 2 months, okay? Mind-boggling, okay? In fact, it kind of blows them away. Usually 30, 40 people in here, okay? Which is pretty cool. So this is just an off night, okay? A lot of things are going on for people. But guess what? They're focused. See, I'm here. The only reason I wouldn't be here is if the guy took me home, okay? Or I'm in a hospital somewhere. Otherwise, I'm here. Or guess what? I'm in another office doing another meeting, which is happening, okay? Because I understand Ryan's targeting now Cape Coral to get an office. We're talking about Lehigh Acres to get one. We'll do one down in Naples, okay? We'll be right here. So we'll go, but we got to grow. So we're looking for like-minded people that, how many of you really didn't know why, but you don't like banks? How many people didn't know why, but you really don't like insurance companies? Okay, you get my point? Neither do we, so we have a crusade. Now you go after them and replace all their business. Does that make sense?
Yep.
So I'm done. Kevin, what'd you like best about what you heard?
The idea of making my money work for me.
Amen. Great answer. Great response. Marcos, what'd you like?
Pay myself first.
Amen. Now, remember we met, and I met Marcos. You know what? He was working in a Home Depot from Lehigh Acres. And he's just being a happy guy standing there with his little red jacket on, and he drives a fork truck or something, and I'm lost as heck. And he saw it. And I asked him a question. And then he was really enterprising. And we started having a talk, and he had a 401k, and I asked him all the famous questions. He's going, whoa. I started asking about his money. And then he was supposed to be here a week ago, but something got in the way. It was probably his girlfriend. I don't know, but it got in the way. He didn't make it, but he made it this week. In fact, he called me, and it was good. I promised I'd get a hold of him. Remember how people ask me for cards? Did I give you one of my cards? No. Guess what? What did I do? I took your name and number. I said, no, I don't give cards. It's a test. I take you. I will call you. Well, he happened to be smart enough to put my number in his phone, and I didn't even send it to him, and he's calling me. How come you didn't send me anything? Oh. He did so good, and then he got an F because he didn't show up last Tuesday. Boom! What do you think about that, Andrew? See that? But he's here this week. And it's so funny, he happened to call. Did I call you? You called me today. I think I called you.
Call me this morning.
I did or didn't?
I was thinking about calling you.
And I beat you to it.
And then call you first.
That's right. And I said, hey, Chumphead, where are you? Okay. Oh, I like, and I sent him an email again. You see, it's just quality of life is the quality of your communication. You get that, Daniel? See, if you communicate, and he was good, he reached out. Now, does everybody do that? No. Everybody's occupied with life. You know what? No, I control my life. Life is controlling a lot of you. Stop it. Why don't you control it? Am I making sense? So, any questions you want to ask at all, Kevin?
No, not at the moment.
Anyone you get, we'll answer. Ryan can handle that one for sure. Marcos, anything you want to add or offer or beat us up on?
As far as like, adding like 2 people, what do you mean like I get 2 other?
Yeah, I'll show you. I'll show you how to do that. Next week you come back, you have this whole roll filled up. Bring them by the busloads. You say you're supposed to be a popular guy. We'll see. He gives everybody food. He feeds everybody. No, I'm kidding. Okay, do you have any questions? Any statements? Nope. Mina?
I enjoy it just like I do every week.
You do?
I learn something new.
Awesome. Nothing to ask. Okay, you just shake your head. It's about time to start doing the briefings. Nicole? How good? All right, good. Javi, you did a good job tonight.
Thank you. Best place to be in the world.
Yes, I agree.
In America, the world, everything.
Okay. Yeah, big things have happened. He's recently gone full-time. He's recently gone full-time. He's talking it. Okay,
My
Frank.
wife didn't take the job, so I'm full-time.
right? Trey Carter just went full-time, but he had a mishap tonight, so he's not here. So say a prayer for him and his wife, okay? Everything's great, but just a mishap in the family. So he's tending the business, taking care of family. So that's good. So it's a wonderful thing. We have a good time. So your only obligation is now is to celebrate Andrew, Ryan, and Shane, and even myself, and give a nice round of applause. Thank you for the gift of your time very much. We appreciate it. That's great.